Imagine putting a few $1,000s into a single company and watching it pay off your mortgage 5 years later. In financial circles, this is called a 10-bagger, an investment that grows 10 times its original value over a decade. It's a goal that drives the entire industry. Yet, the most common advice you'll hear is to do the opposite. Buy a broad index fund and ignore the market for 30 years. If professionals can pick winners and generate massive wealth, why is the average person told to sit on the sidelines and settle for market averages? Friction costs, the time and money required to pursue better than average returns, reveal a gap. When investing, you face a fork in the road: passively indexed or actively manage your money. If active, you can pick stocks yourself or pay a mutual fund manager. Miscalculating your own resources here has consequences. Choosing a path that doesn't align with your available time or capital can lead to an erosion of wealth through high fees or behavioral traps. The first path was paved in the 1970s by John Bogle, who pioneered the passive index fund at Vanguard. He proposed that instead of picking winners, investors should simply buy tiny pieces of every public company at once. This strategy requires practically zero time, no fundamental analysis, and the lowest fees in the industry. In exchange, you capture the exact average return of the broader stock market, minus a tiny fraction of a percent. This provides the free lunch of diversification. Because you own the entire market, the failure of any single company barely impacts your total portfolio. By structuring a portfolio that cannot significantly underperform the market, you accept that you will also never outperform it. To try for those higher returns without doing the research yourself, you can outsource the work to a professional mutual fund manager. While it's popular to think these pros are just guessing, academic data shows that many active managers possess genuine, persistent stock-picking skill. This chart shows how value added scales over long horizons. According to this research, the average active mutual fund extracts about $3.2 million a year in value from the market through their expertise. This talent-driven profit, before any expenses are taken out, is known as gross alpha. However, accessing that skill requires you to pay a percentage fee based on your total assets under management. What remains is the net alpha, the actual return that reaches your pocket. On average, this net return for investors is essentially zero. Mutual fund companies typically price their fees to match the value their managers create. If a manager has the skill to beat the market by 1%, the fund often charges that same 1% in expenses. You take on the risk of active management, but you take home the returns of a passive index. These fees drive many to the DIY route. Legendary manager Peter Lynch famously suggested that everyday people have an edge over Wall Street analysts because they notice trends in their daily lives before the experts do. This advice is often simplified into buying what you know. Investors buy stock in their own employer or local businesses they recognize, assuming familiarity is the same as an advantage. A study from CBS News found that this behavior leads people to overweight their portfolios in their own industry of employment, concentrating their savings and their salary in the same place. Casual retail picking often leads to a 5% negative alpha compared to the benchmark. On average, the stocks these individuals sold actually outperformed the ones they bought. Familiarity often breeds a false sense of confidence, leading to excessive trading and lower returns. Peter Lynch's actual strategy required much more than just spotting a popular product. He insisted that any discovery must be followed by a deep dive into the company's financial statements. He utilized a framework called GARP, growth at a reasonable price. It's a hybrid approach that searches for businesses with high potential without overpaying for the stock. This requires strict mathematical filters. First, you hunt for a PEG ratio of less than 1, meaning the price is justified by the earnings growth. You then look for a return on equity greater than 15% to ensure the company uses its capital efficiently. Finally, you verify financial health by checking for a debt-to-equity ratio of less than 0.5. This process results in a concentrated portfolio of 8 to 12 companies that have been thoroughly vetted for their 10-bagger potential. The trade-off for DIY active investing is a part-time job. It requires hundreds of hours of homework and discipline to hold through market panics. Active management can work, but the market ensures you pay for the privilege, either with your time or your money. If you cannot commit hundreds of hours to balance sheets and you want to avoid high management fees, your strategy belongs in the passive index quadrant. For most investors, capturing the market average provides the highest probability of long-term success with the lowest possible effort. If you choose the active route, you enter the high-effort quadrant, which requires you to abandon casual shortcuts in favor of rigorous research. Investing success depends on patience and self-awareness. Decide honestly how much of your time or capital you are willing to spend. Attempting to get an active outcome with a passive amount of effort is a gamble that rarely pays off.